Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Managing Director on Nasdaq's Market Intelligence Desk. We will also have Brian Joyce joining us remotely for some technical updates on the chart. We also have Phil Mackintosh, Chief Economist at Nasdaq, as well as Ed Egilinsky with Direxion. It is great to have everyone with us, and really, the story has been this economy that appears to be bifurcated, Ed.
Yeah, definitely. I mean, it's been really a select few that have carried this market. The Mag 7, for example, when you look at that, the return stream of the Nasdaq 100 or the S&P 500 this year, over 60% could be attributed to those basically six stocks, because Tesla has not participated this year. You're also seeing it in large cap versus small cap. This has been unprecedented in terms of the length of time where large cap has outperformed small cap. So maybe there's going to be a reversion to the mean. It's going to happen at some point, but certainly the large cap rally has extended longer than the typical duration, which is about 11 years. Now we're on 13.
Yeah, I mean, it really has been, Phil, and you and I go back and forth with this. Are we perhaps in what's a normal environment, and the past 10 to 12 years was an anomaly?
I mean, what's been interesting, though, with the bifurcation is the earnings have supported it. So the larger companies are actually growing earnings. It's not like the tech bubble back in sort of the early noughties. These large tech companies have strong margins, strong revenues, strong revenue growth, and they keep hitting targets. So they are actually performing in line with their earnings. So it's fundamentally based. It's not a stretch in the price earnings multiples.
Yeah, and Max, another thing we've been talking about is the bifurcation that we're seeing in the market as well, to Phil's point, where there's been a handful of stocks, and then there's the other part of the market, but investors seem to be really discerning, and they want more just because it's a good valuation, but they want to see a solid business.
Yeah, they need to have a good business. They have to be, expanding and growing, because that's what's been working. And even Mag 7, we're talking about the bifurcation between large cap and small cap. Even the small cap now is in the Russell 2000, it's the Russell 2, right? So those two, MicroStrategy and Super Micro, going to be moved up. Super Micro, S&P 500, and Russell 2000 is the first time that's ever happened there. Those two have accounted for the vast majority of any performance that you've seen in the Russell 2000 so far. So they're getting moved up. So then is that you see an even bigger drift potentially between the large caps and the small caps, with the small ones that have really been kind of holding them up, so it doesn't look as bad as it actually has been. See if that continues, but again, like you're talking about, Phil, it's not like the .com bubble where it's just, all right, we got a website and this idea. There's real earnings behind it. There's real money flowing to it. How long that's sustainable to continue to grow at these rates, that might be another question. But it's real, and until that stops working, those are the real businesses that are growing. That's the trade that's working. So investors are saying, okay, if I'm not going to find anything that's working smaller, I'm just going to stick with this until it stops.
It is interesting looking at global returns. Like almost all the markets in the world are up this year. And if you see the reasons they're up is partly because interest rates are coming down, so you're getting multiple expansion, but earnings are growing too. So they're growing stronger in the Mag 7, but they are growing across the board. So the news is actually pretty good for companies. They're starting to see recoveries in earnings, recovery in the economy, interest rates coming down. Like it's all been quite supportive for stocks globally.
Just to add on what Phil is saying, I look at the Mag 7, for example, and the valuations are frothy, I think, on a relative basis when you look at their growth. Maybe you wouldn't put Meta and Google in that bucket, but it's still a stretch. You're talking about maybe low to mid double-digit growth for them with a 25 plus PE. But I look at Microsoft and Apple, right now, based on their growth rates and where their PE is, I would say it looks stretched, in terms of that. Not to say that it can't continue to support the higher multiple because of being cash rich and the other things that they have going for them. So
right.
And it's a big AI trade too, isn't it? So all those companies are positioned for this AI transition and what it's going to do to their revenues if we're all going to be using AI to replace people in the office and do a whole lot of more productive work.
Mm-hmm. Well, I also think we have to take a look at rates here from a technical perspective as well, because a lot of the small cap story is predicated on what happens there. So I want to bring Brian Joyce in, our resident technical analyst on the Market Intelligence Desk here. Brian, let's take a look at a couple charts here. The TLT, which of course is the ETF that is well known for trading as a bond proxy, as well as the 10-year. What can you tell us from a technical perspective?
Certainly, Jill, and thank you as always for having me on. So looking here at the 10-year Treasury yield, you can see that it peaked in April. Its 2024 high around 4 3/4. It's since been in a 2-month downtrend. We broke down below that 4.35%. It was a significant top in October 22, which held for about 10, 11 months or so. More recently, we've dipped back down below that level. And we've also pierced below the 200-day moving average. Today, we're seeing a little bit of a reflex rally higher. I think this Friday's PCE number will be the next catalyst to determine where rates go from here. But we've been in about a 2-week sideways consolidation, right around the lows between 4.2 and 4.3%. And so when we look at the TLT, which is the 20-year Treasury bond ETF, and there's levered products off of this, like the TMF, we can see that this is 2 weeks ago broke back above its 200-day moving average. This is a weekly period chart, so that yellow line is the 40-week moving average. I'm not sure if you can see that there. And it's also kind of broken down below this this declining trend line, connecting the high from the second half of 22 and the weekly closing high from 2023, which was reached back in April. So we can see that price has been respecting that downtrend line. And just 2 weeks ago, we kind of broken back above it. So we've been consolidating the last 2 weeks here, and maybe we can see if this is going to, resume this recent trend higher in prices for Treasury bonds.
All right, Brian, we'll see you in just a moment. I want to talk about small caps here. So, Ed, as the head of sales and distribution and alternative investments at Direxion, you have really good insight in terms of what investors are trading. So from a small cap perspective, what are you seeing in the ETFs in terms of how they're positioning?
Well, we have tactical trading tools, triple leverage bull and bear on the Russell 2000. So this year, Russell's been basically flat. Hasn't had much discernible direction to it, no pun intended. So we're seeing flows both in our triple leverage bull and bear TNA and TZA. I will preface the fact that these are designed for short-term active traders as well. Just one thing to add to the charts. Our biggest inflows year to date are the triple leverage 20-plus year Treasury bull, TMF, as what was alluded to there. And it's interesting because the fact is TLT for the most part has been down this year, although it's rallied a little bit recently, but we continue to see inflows, and their largest inflows year to date of any of our Direxion trading tools has been the 20-plus year Treasury triple leverage off of the TLT.
Well, I mean, that's what Direxion's known for, of course, is the leverage that you provide within the ETF wrapper. So, I mean, that certainly does express an opinion.
That opinion, for the most part, this year by the short-term trading community has been wrong until recently.
Yeah. So, Max, your perspective on the desk is, of course, you're covering Nasdaq-listed companies, and many of them fall within the small cap arena. Anything you can discern from what you're hearing from companies in terms of how they feel about the economy, their outlook? We're heading into earnings season in just a couple weeks here.
Anything I've heard has been they're more constructive about the future. The big worry had been for months, as we talked about, essentially for the past year at this point, where are rates going? When are we going to get the cuts? How's that going to impact us? Everybody seemed to has taken this long to get a cut. Well, obviously we haven't got one yet. They're more comfortable in the current operating environment. Again, there's some that have gone out, cut their short-term debt, and actually put on some more longer-term at reasonable rates, where they're comfortable taking that on, being able to sustain it, and they're not as worried about missing something or putting it on too soon and almost trying to trade the market. Just actually putting on your debt, operating your company the way it needs to be going. And again, they're just more comfortable with it. They're not desperate for the cuts, whereas a lot of times it was, all right, we're going to just keep it rolling over short term, and wait for the cuts to come. Everybody's kind of, I guess, the new normal where they're operating here. They understand they're modeling it out where they say, okay, I can factor this in and I know what it's going to do to margins, and we're okay in this space and we don't have to go out and really worry about it. So they're again just more comfortable with the higher for longer new normal. We're not going back to zero interest rate policy again. So they're not expecting us to go back down there. They're just comfortable and they understand that they can operate their business in this environment.
Right. Well, I mean, Phil, to your point earlier, they are operating quite well for the most part.
Yeah, I mean, what's interesting about small cap is they have quite a lot more variable rate debt than large cap companies. So as rates have gone up, you would expect it to hurt their margins more than the large cap space. But actually, interest cover is pretty well covered. Yeah. So interest expense hasn't really dragged on corporate profits the way you might expect, with interest rates going up quite as much as they have.
Yeah. Let's bring Brian back in for a moment here for a technical read on the bifurcation in the market, Brian, that we've been talking about. The Mag 7-6 versus the equal weights, and also what you're seeing from a technical perspective as it relates to the small caps.
Sure thing, Jill. So we could see here the year-to-date performance Mag 7 is up about 35%. The S&P 500 weighted index in orange here is up about 15%. And then, the rest of the marketplace, so I have the S&P equal weight in green, up less than 5%, 4.5%. And as Ed alluded to earlier, small caps are essentially unchanged year to date. And so, small caps, as we can see, if we want to look directly at the small cap index, we can see it had a very nice move in the fourth quarter, is one of the top performing major indices based on its performance in November and December. And accordingly, over that time period, as you alluded to earlier, we saw a sharp repricing on the yield curve where there's a dovish move in rates with expectations of as many as 7 rate cuts by the early January of this year. And as that hawkish repricing has since taken place throughout 2024, small caps have just been in this sideways range. I think this, from a technical standpoint, this is the Russell 2000. We see a potential kind of large consolidation pattern here. Technicians refer to it as inverse head and shoulders. So as long as we don't lose these recent lows that were made earlier in June around 1990, 1993, I think that's a potential outcome where we're just consolidating over many months, 4 or 5 months. I think obviously what happens with rates, inflation measures, things like that will maybe be a large factor in determining which way this plays out. If we're looking at the relative performance of small caps versus the S&P 500, this is a monthly period chart going back to the early 1980s. We could see currently this has been in a sharp downtrend that actually peaked about 10 years ago as its cycle highs back in 2014, and it's just free falling over the last month or two, especially as those large cap names have grossly outperformed, and we're currently this ratio is currently at 20-year lows right now.
All right, Brian. I want to switch gears for a moment here, Ed, and talk about what you're seeing in terms of the energy and gold trade, because really, I would imagine from a tactical perspective, we have to start thinking about, well, how are we going to power all of this AI, the data centers, EVs, all this technology? I mean, the product is there, but you've got to make it get from A to B.
Well, yeah, without a doubt. And I think when you talk about technology and the evolution of it, you have to mention commodities in the same breath, because the AI data centers, you're going to need natural gas and other forms of energy to power that and to support the grid. At the same time, though, for the utility companies, you're going to need copper and other metals as well. So right now, crude oil is basing here right now at this point. You have a seasonal potential rally in the summer with crude oil, but I think there's a floor under it right now, the risk premium as a result of what's going on with global tensions right now. So I think it is trading probably higher than it would be otherwise based on the fundamentals that may not support it, but that risk premium with what's going on from global tensions has definitely kept that elevated. We're seeing a lot of activity in our trading in energy stocks. Some of your clients might be familiar with XLE and XOP that track the Energy Select Sector Index and the S&P Oil and Gas Production Index. We have 2x bull and bear on both those indices, so people could play the short-term trade in the energy stocks, not the crude oil itself. Both bull and bear. So we're seeing some activity there. As far as gold is concerned, it's interesting, and I'm sure Phil can touch on this. I'm shocked that gold's up as strongly as it is this year based on the dollar strength and with interest rates climbing higher. But when you look at what's going on from a geopolitical standpoint, as well as central bank buying, that's probably what's fueled gold to new highs in May, and it's fallen off a little bit. But I think there's definitely more upside in that gold trade, especially with elections coming, not just in the U.S., but also in France and England that are coming up over the next couple of weeks.
Yeah, I mean, it really does change the calculus here.
Yeah, I mean, commodities, we were talking before COVID of a new super cycle, strong commodities going through. It hasn't actually come back now that we've recovered from COVID, and I think that's because China is a lot weaker coming out of COVID just because of its property exposures and an underlying economic position. And so the commodities space hasn't got back to the levels we were kind of expecting to see before we went into COVID.
Yeah. All right. Well, let's bring Brian one more time, right? Let's see what the charts are telling us, because at the end of the day, it's price that confirms what we're thinking. Let's take a look at some gold here, Brian. And I bet you're on mute.
Brian.
Jill, can you hear me now?
Now we can. It's new.
Okay,
Can
sorry
you hear
for
me
that. technical difficulties on my side. This is a monthly period chart going back to 2001 in gold, and you can see when gold had a strong run of 10 years up to its high in 2011, gained over 650%, and then had this long 10-year consolidation with cup-shaped formation, and then when it reached that prior high back in summer of 2020, we're kind of coming out of COVID. It then entered into a 3+ year consolidation in a sideways range. So we've seen over the last 4 months or so it break out of that range. Finally, it's breaking out to new all-time highs. And so this range from this prior 10 years, from 2011 to 2021, was about 875 points. So from a technical point of view, we use that to project our upside target, which from traditional technical analysis would take it to about 2,800. There's no time frame for that price projection, but from a traditional technical perspective, that would be the expectation of where gold is going to go into the future. My concerns about gold is that typically, two things: the relative strength of gold to silver. So silver is still about 72% below its prior all-time highs, which were made back in 2011. And gold, when it's making new highs, you would expect silver to be doing the same thing, and it's not. Silver should be outperforming gold when gold is in a strong uptrend. The other concern I have is its relative strength to equity. So you can look here. This is a ratio in the upper panel of gold to the Dow Jones Industrials going back into the 1970s. And if you use a 48-month moving average, when that ratio is above that moving average, we could see now in the lower panel that gold tends to be in a long-term trend. When it's above the ratio, when the ratio is above the moving average, gold itself tends to be in a long-term trend. This worked really well from the early 80s into 2001, almost a 20-year period, where the ratio to equities was below its moving average, and gold spent 20 years, basically sideways to down. So that would have using this as a signal, its ratio would have kind of kept you out of being overweight or long, precious metals, particularly gold. It worked well from 2001 to 2011, and we've seen more recently that this ratio has been consolidating right around that moving average. And so as gold is breaking out, we haven't yet seen its relative strength to equities begin to do the same thing. Not that it has to, but historically, that's pretty been a good indicator for a long-term trend.
All right, Brian, appreciate the technical insight as always, which is interesting. We had another guest point out earlier in the day that, there's stock bond correlation regime that's positive as well, which typically indicates that things are looking up, right? So then it feels as if everything's kind of trading the same way, but fixed income and equity markets are saying two different things. So it's interesting to see how these correlations are starting to come into play right now. It's almost like we're at an inflection point.
Yeah, I mean, we saw with stocks and bonds, last year, where it was kind of going counter to what you were expecting. Everything kind of moving the same way. It's been a little bit skittish. When everybody, we were talking about it yesterday, herd mentality. When things start going where everybody is kind of on the same side of a trade and thinking everything is rosy, it's usually when something comes out of left field that you're not expecting and takes everything down. And again, we were talking about cuts, earlier, before the year started, we were expecting 6 cuts. Now we're down to 1.5. So we've obviously continued to grind higher, but what happens after that first cut? What is the impetus behind that first cut? Is the inflation numbers coming down? Is there softness? And do we start to roll over there? I mean, that's
right.
typically been the signal. You get the first cut, and that's when your markets start to fall. So we're getting closer.
So Ed, in the final minute here,
Yep.
when you think about everything that Max just alluded to, what's your outlook for the remainder of the year?
Well, I think for us, we're agnostic. The one thing I would say, though, is that commodities, areas that don't correlate to stocks and bonds, because in 2022, bonds failed you, and they weren't a defensive play. So I think it's important for investors to look at a diversified portfolio outside of stocks and bonds by adding things like commodities that have a low correlation historically to that. But right now, I would say certain parts of the market are definitely inflated. Will there be a rotation? That's the big key and the million-dollar question right now. I don't see the Fed doing anything, though, until after the election. I think there's a lot of political implications to that. So it'll be interesting. People are expecting these cuts, and if inflation remains this sticky, I don't know if that's coming necessarily in the near term, as some of the Fed members are saying, including yesterday.
Seems to be the catalyst. All right, appreciate everyone's insight as always. Thanks for joining us on Trade Talks, and thanks for joining me for MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.